For those of you who may not be familiar with First Community Foundation and its relationship to First Community Church, let me just summarize something. We are a partnership. We work in tandem toward the common goals to support the mission and ministries of First Community Church. The church governing body appoints the trustees of the foundation. So we're one in spirit and in purpose. Both very dependent on donor generosity and God's grace. There are three sections of the agenda. First of all, we're going to talk about how the tax laws may impact your charitable giving. Then we're going to talk about how to choose the best vehicle for your charitable giving. We have some handouts that we're going to be going over. And lastly, we're going to be talking with some real people, not that nobody else is real, but we're going to talk to some people who have actually chosen to give their charitable gifts through one of these vehicles that we're going to be talking about at our table. I'm going to introduce Jim Hutchins, who's a member of the Board of Trustees for the foundation. He's been with us for 4.5 years. He still looks pretty good after all that time. And he's been with the church for more than 50 years.
I was 6'2" when
He was 6'2". Get up.
Well, greetings, everybody. I'm Jim Hutchins. I'm the chair of the investment committee, so I've been chosen to introduce Johnson Investment. First off, I want to thank them for being a co-sponsor. That was so nice and generous of them to do that. The investment committee has responsibility for the funds and investments of the foundation, and as part of that responsibility, it's investment committee's responsibility to choose an investment advisor. So about 4 years ago, the investment committee decided that we needed a new investment advisor. So we went looking and we interviewed lots and lots of people, and we finally chose Johnson. And I have to say that was a pretty good deal. So after a very strenuous search, we chose Johnson. So I want to make sure that you all understand that the investment committee and the foundation board, one of our big fiduciary responsibilities is watching for the investments. And please be advised that we do that very carefully. And that's why we chose Johnson. I want to tell you a little bit about Johnson's. They're done a great job for us. Their rate of return since they've started 2.5 years ago is at 10.7%. Does anybody beat that? They're the largest independent investment advisor in Ohio, and I would like to congratulate them because just within the last week or so, they've been named as one of the top 40 independent investment advisory firms in the United States by Barron's. So that's great. So since we're really close on time here, we're not going to have a formal introduction, and there's bios in your package, so we don't need to go through all the initials and everything after everybody's name. But I just want to quickly introduce them. Michelle Stroh, would you stand up, please? She's a portfolio manager in Columbus, and she's the foundation's investment advisor. Dan Gusty. He's a portfolio manager in Columbus, and he'll be doing the tax presentation. Michael Barnes, who is from Cincinnati, he's an attorney, and he's the president of the Johnson Trust Company and Johnson Charitable Gift Fund. So we appreciate you coming all the way up from Columbus. Michael Tim, who's a portfolio assistant in Columbus. Jared Levinsky, who's a portfolio manager, and he came all the way up from Cincinnati. Thank you for doing that. And Megan Everhole, who is a portfolio manager in Columbus. So that's our team. So Dan, would you like to start, please? Thank you.
You know, Lynn, I really like your quote from Aristotle. I've done several charitable presentations before, and Aristotle, maybe you knew or did not know, was really the first philanthropist, and he actually opened a school that started accepting charitable gifts as one of the first charities in the history of the world. So a really neat quote from somebody who is really the father of modern philanthropy. So thank you for sharing that. Well, Jim mentioned that we all have initials behind our names. One of my initials that doesn't make me the most popular person at a cocktail party is CPA. And so as a CPA, I'm going to talk about a topic that I think is one of the most interesting topics we could talk about, and I'm sure you would all agree, very interesting topic. We're going to talk about the new income tax plan. So there are refreshments in the back. I noticed there was coffee. I won't be totally offended if anybody makes a trip back there to the coffee dispenser. So just to start out, quick history. As I'm sure many of you are aware, last December, Congress passed and the President signed into law our new tax plan, specifically the Tax Cuts and Jobs Act of 2017. And it really made sweeping changes to not only our individual tax system, also to our estate tax system, as well as business and corporation tax and flow-through entities like partnerships and S corporations. And so we're not going to cover the business aspects tonight. We're just going to talk about the individual and estate tax planning strategies that we could utilize and how those can impact our charitable gifting as we move forward. So to begin, I thought I would give us a little bit of perspective on where we've come from and where we are today. So I thought we would hop in the Johnson Investment Council time machine and go all the way back to 1913 when the first income tax return was levied on citizens of the United States. And so if we look at this, I think it's pretty interesting. It's a very simple tax return, gross income, minus deductions, and the deductions are pretty interesting to look at. There were state and local tax deductions. There was deduction of interest, not just mortgage interest, but any interest. So if credit cards would have been around in 1913, you could have deducted that interest back then, conceivably. There were also deductions for casualty losses. Probably one of the most interesting things that's explicitly named as a deduction was losses from a shipwreck, which I don't think many of us will be claiming those on our tax return. And then there was also a reasonable amount for wear and tear on business property, assets. So imagine that, the federal government giving you some, a little bit of a liberal definition of what wear and tear is. And so then you added in any dividends and interest in terms of income. You took a $3,000 to $4,000 exemption, and all of a sudden you had your taxable income. Tax rates were pretty different back then too. So if you probably can't see that in the back because I really can't see it from here. But the first $25,000 of income, which doesn't sound like a lot today, was taxed at a marginal rate of 1%. So if you had $25,000 of income, you were paying, what's that, $250 in tax? $25,000 in 1913, could anybody guess what the value of that is today? It's about $700,000, $678,000 to be exact, if you look at inflation. So the vast majority of the country was paying a 1% federal income tax. The highest marginal bracket back then was 6%, and that was on incomes over $500,000. So, again, the equivalent of that today is about $12.7 million. So maybe that was Carnegie and Rockefeller and J.P. Morgan were paying that hefty 6% federal income tax. So if we fast forward to today and look at what the previous tax rates were compared to where they are today, they're certainly very different than they were in 1913. But in modern history, they're at the lower end of where tax rates have been. So you can see the 10% rate really pretty much stayed the same. We had a slight bump for inflation. 12% replaced 15%, 22 replaced 25, so on and so forth up until we hit the top tax bracket at 37% over $600,000 of income. And this is for married filing joint couples. So tax rates moved down significantly, but with this tax law, for every deduction that they gave, they wanted to pay for that in some other way. So one of the changes that they also made that was more of a deduction was they made changes to the alternative minimum tax, which, raise your hand if you know what that is and know how to calculate it. Oh, everybody's hand went down when I said know how to calculate it. Not something you can do on the back of a napkin, unfortunately. But the new tax plan made a lot of changes to alternative minimum tax so that really only a very, very, very small percentage of the population is going to be subject to AMT. They made phase outs of $500,000 for a single filer and $1 million for a married filing joint filer. So probably about 0.4% are going to be subject to AMT on any given year. Capital gains tax is another one that's very important for us, certainly in the investment management business. When we have all those gains, we want to understand the taxes around them and make sure that we can manage those tax expenses. They didn't make any changes to capital gains taxes, so those rates remain the same. If you make over $450,000, you still pay the 3.8% Medicare surtax, which is related to the health care bill. And there was also no change on the home sale exclusion of $500,000 when you sell your home. So now I want to transition to the area of the individual tax return where really the most changes were made, and that's to the itemized deductions and also to the standard deductions. So this is a schedule that I'm sure many of you are pretty familiar with. This is Schedule A, the itemized deductions for 2016. Looked exactly the same for 2017, but it's going to look very, very, very different come 2018 because there were a lot of changes that were made here. So before we delve too deeply into that, want to look at the standard deduction, because as tax filers, we can take a standard deduction or an itemized deduction. And since we want to pay, typically, I've never met anyone that wants to pay more tax than they have to. But if you have more itemized deductions than you have of a standard deduction, you're going to be an itemized filer, and vice versa. If the standard deduction is higher than your itemized deductions, you're going to use the standard deduction. So under the old tax regime, about 70% of all filers use the standard deduction. And in 2017, for married filing jointly, that standard deduction was $12,700 and half for a single, $6,350 for a single. Under the new tax plan, you can see the increases. The married filing joint essentially doubled, as did the single deduction. So because of that, that's placing many, many more people into filing as a standard filer. So it's estimated that about 90% of filers are going to use the standard deduction. And what that means is that if you had, property taxes, state and local taxes that you paid, charitable gifts that you paid, mortgage interest that you paid, and all of those things don't add up to at least $24,000, you really get no tax benefit for those things anymore. So we want to come up with strategies that can help you to utilize the tax advantages and still continue to give monies to charities that you really, really care about and do so in the most tax efficient manner. One of the other changes that came with the increase of standard deductions was they eliminated exemptions. So for each of us in our household, we each got an exemption. And that was $4,150 in 2017. So for a family of four, if you looked at their standard deduction of $12,700 and then four exemptions of $4,150, you had a deduction right there of $29,300. So it's pretty simple. If we look at that, that's more than the married filing jointly deduction now. For a guy like me who has four kids and a family of six, I was getting $37,600 for exemptions and standard, and I'm frankly not going to be there with itemized this year. So to help with the elimination of some of those deductions, they increased the child tax credit from $1,000 to $2,000 and increased the income limitations up to about $500,000. So made that deductible for many, many more people. As far as the itemized deductions, there were changes to state and local taxes that were made where you can deduct state and local taxes, income taxes, property taxes, but only up unto $10,000. So if you have $40,000 of state and local taxes and property taxes, you only deduct $10,000. Now, one of the things to remember is about 80% of itemized filers in 2016 were also subject to AMT, that alternative minimum tax that we don't know how to calculate. And one of the things that AMT does is it eliminates the deduction for state and local taxes. So while this provision looks somewhat negative, for most itemized filers, they really weren't benefiting from state and local tax deduction anyway. Mortgage interest is also limited. You used to be able to deduct mortgage interest on loans up to $1 million. That's now $750,000. And you can no longer buy a car with your home equity line of credit or pay off credit cards and continue to deduct that interest. Medical expenses have also been changed to some extent. If you have a lot of medical expenses, you can deduct those if those medical expenses exceed 7.5% of your adjusted gross income. And so that was another change. Getting to more of the meat of our discussion today, looking at charitable deductions. The new tax bill preserves charitable contributions. It actually expands the deduction for charitable contributions, where you can deduct 60% of your adjusted gross income if you make a cash contribution. Formerly, that was 50%. So if you make $100,000, you can take $10,000 more in a cash contribution that you can deduct this year. If you're gifting any type of property, appreciated stock is the thing that we gift most often. You can take up to a 30% of your adjusted gross income deduction there. And P's limitations, I won't go too in-depth into those because they're gone. They've been eliminated. It was something we used to have to worry about a lot, but fortunately now we no longer have to worry about that. So if we look at what the Schedule A of itemized deductions looks like now, I don't think the IRS is going to put big red X's on the form like this, but those sections are going to be eliminated and reduced. And so it will be a little simpler to fill this out. But I think one of the main points here is that if you think about this, and you think about from a charitable perspective, if really your only deductions, medical expense deduction, that's not going to happen for most people. You're not going to exceed 7.5%, so we'll throw that deduction out. Your other deductions are state and local taxes. Well, those are capped at $10,000. Then you have interest on mortgages that you can deduct, and you have charitable contributions. So if you do pretty simple math, for a charitable contribution to be fully deductible, you would need to max out on your state and local tax deduction at $10,000, and you would need to have a mortgage of about $400,000 to $450,000 based on your interest rate. And if you don't have those things, the deduction for your charitable contributions is going to be somewhat limited. So I think that's a surprise to a lot of the people that we talk with. So with that being said, I'm going to hand it over to Michael Barnes, who is the head of our trust company, and he's going to talk a little bit about estate and gift planning.
So Dan sounds more like a banker than a CPA to me. He says you need a mortgage. Dan says he's not the life of a party being a CPA, so I'm up here to talk to you as an attorney. And no one in the room could tell an attorney joke I haven't heard. But hopefully what we're trying to share with you today is certainly the tax laws that constrain and affect how we live our lives, our financial lives, and how we manage our net worth and our wealth at the end of our life. Dan's been talking about taxes that you have to pay. I'm going to talk to you about taxes that you might not, and if you do charitable giving, don't have to pay. And those are gift and estate taxes. As everybody probably knows, in America, we tax the transfer of wealth from person to person or generation to generation. If it's a transfer during our lifetime, it's a gift tax. If it's a transfer at the end of our life, it's an estate tax. So changes also happened to the gift and estate tax laws with the most recent tax law change. We all may be aware that there is an exemption amount. There's a tax-free amount that every individual in America can transfer without any gift or estate taxes. Earlier, at the end of last year, that exemption amount was about $5,490,000. It was doubled with our new tax law, but with the way the government does math, they doubled it to $11,180,000. So every American can give away $11,180,000 without paying a gift or estate tax. So doing the math, a couple can give away $22,360,000 without ever having to pay a gift and estate tax. So America, I'm glad to tell you, almost all of you, that the estate tax law has been repealed for you. For those that may have a net worth above that and may face estate taxes, that tax rate is still 40%. But one of the good things that was left in the estate and gift tax law that would perhaps affect many of you in the room is that at the end of someone's life, if they have appreciated assets, so they have assets they bought at a low price and those have gone up to a high price, at the end of their life, because their estate is being potentially exposed to the estate and gift tax law, their estate is allowed to increase their cost basis from whatever it was during their lifetime to the value on their date of death. So for us in the financial planning business and estate planning business, a lot of our clients, though they may not be worrying about the estate tax, we are doing lots of planning to find ways for them to maximize these increases in cost basis at each spouse's death. And that has a lot to do with how your estate plans are written. Some estate plans are written for an old tax law, or a tax law of 5 or 10 years ago, probably need to be updated because there are tax savings opportunities, not estate tax savings, capital gains tax savings, when one spouse dies and then when the second spouse dies. So I could talk a little bit more about that after our meeting. I could probably talk about that for about 3 hours. So we also wanted to share with you today is our approach to helping our clients with their estate plans, whether they have a taxable estate or not. And we have found we can talk to them about charitable remainder trust, charitable lead trust, all kinds of income respective of deceit, all kinds of technical things, and none of them do anything. So what we have found is if we instead talk to them about these 3 questions, it can really put them in charge of the direction for their estate plans and really give their attorney and their other financial advisors a good direction. So our first question that we have them focus on, and with these we're really trying to help them quantify answers, are what do you need to hold at the end of your lifetime to feel financially secure? Some of our clients, the answer is all that they have. Some of the clients, their answer is less than what they have. And that identifies assets that they might want to give away during their lifetime. The second question is, what do you want to leave your family and how? And there's also not only how, but when. Do you want to give it away while they're buying houses, having children during your lifetime? Or do you want to give it away at the end of your life? And then how do you want to leave it to them? Does it need to be protected from spending or ex-spouses or business liabilities, things like that? So the second question is where we talk about that. And the third question is, what do you want to do with what's left? It used to be 5 or 10 years ago, probably everyone in the room might be touched by an estate tax, which I used to always say was forced philanthropy. You have to give to the federal government those estate tax dollars. But you can divert those to charity if you wish. And we'll talk a little bit more at the end of our presentation about some of the more creative ways that you could do that. So thank you very much for coming.
Okay, so I'm back. I thought of like 3 attorney jokes I wanted to tell, but maybe I'll save those for my table. So looking at all these different changes that have been made, one of the questions that we're asking ourselves, charities are asking, you as donors are asking, is will charitable giving decrease and how will charitable organizations be affected? And so, we're looking at this. We're looking at a lot of surveys that are being done as givers have been surveyed about why they give, whether it's for tax reasons. And that's typically the last reason they give. That seems to be more of an ancillary benefit to giving, is the reduction of income taxes. And if you look at those studies compared to the fact that the average gift that each individual makes on an annual basis is around $2,500, those gifts probably aren't going to go away, because even at the highest marginal tax bracket of 37%, that gift is really only worth about $925. So that's not going to have a huge impact. But what the change is going to be is we want to make sure that as we do planning, as we work with our clients, we work with the charities who we manage money for, we want to make sure that we are able to provide advice and strategies to make your giving as tax efficient as possible. And so each of us are at your table. We're going to walk through a couple of case studies, and a couple of best practices, and certainly feel free to ask questions of the Johnson rep at your table. Thanks a lot.
It's now time for table talk. So you can do introductions or whatever, but I would dig right into the questions.
It sounds like we've had quite a bit of good conversation. If you have more questions, we're going to be around after the presentation of the panel, so we appreciate your time and interest. Anyway, I'm going to reintroduce Michael Barnes. He's going to come up and talk about some estate planning techniques quickly before we go to the panel.
Can we advance forward? I don't know about your table, but mine was a stimulating conversation. Taxes are so fun. If we could go forward to all the way through the very next to last page. So one of the things we haven't talked about is charitable giving from more tax-driven or income tax-driven perspective. And I'm not going to go into a lot of details. I have 2 nanoseconds to talk about a topic that I could talk for a week. But I think what we wanted to help you think about is there are different ways that you can make charitable gifts that can provide very appealing financial planning benefits to you, as well as income tax advantages. Many of these ideas up here are not estate tax driven, like we said. That's been repealed for almost all of us. These are income tax driven types of strategies. And I've kind of bunched them into a couple of categories. I encourage you to think about them. Some of these you may have heard about from other charities or from your church or from your attorney or tax advisors. The first category is you can make a charitable gift but keep the asset. Obviously, if you have a bequest in your estate plans for the church, you get to keep the assets during your lifetime until you're not here. The example that the pastor they gave of the lady with the house in San Diego, great example. She used it till she was gone, and then she made a very nice gift. I used to work in the couple of different universities in charitable gift planning, and by far the largest gifts we got to the university was from bequest gifts. Gifts from a retirement account. I talked about it at my table. If you leave an IRA to your children, that's untaxed income. When they take those IRA dollars out, every dollar, they pay income taxes on it. It's not unusual for me to meet with a client where they are leaving their IRA to their kids, because everybody says you're supposed to defer the income tax as long as possible, and they're leaving a nice bequest in cash to their charity. They should be doing the exact opposite. When you leave the cash to the kids, they get all the cash. There's no income tax to be paid. When you leave the IRA to charity, they get all the assets because they don't have to pay any income taxes. So that's a thought I leave with you. The second concept is that you can make a gift but keep the income. Charitable remainder trusts are the most common approach. That's a trust where you put assets in, you keep an income back for the rest of your life, and when you're gone, those assets go to charity. That's a tax-exempt trust, so you can convert highly appreciated assets into a higher income stream without paying capital gains taxes. That's typically where we use charitable remainder trusts. A third category is that you can give the income to charity but keep the assets for your family. A charitable lead trust is a similar kind of trust where you put assets in, annual distributions are made to charity for a period of time, and then the assets go to your children. And there's lots of estate tax planning reasons why you might want to do that, maybe income tax. And finally, you can make a gift but give away make the grants to charity later. And a donor advised account and a private foundation are good examples of that. I didn't talk at my table. Here's a bonus. Well, how are you going to bunch those gifts? Where are you going to put those when you need that charitable deduction, but maybe you don't want to give all those assets in that bunch year? Well, the best place to put that is into a donor advised account. Think of a donor advised account as a charitable checking account. I can make deposits in, and I can make grant checks later. Okay? I'm happy to talk about those ideas later after the presentation. Thanks for your time.
Will the panelists please step forward? We're going to morph right into this panel and talk about how some actual case studies of people that have tried some of these tools or using some of these tools in their experience. And our moderator is Jim Hutchins.
Thank you. And one of the things that what we're trying to do here tonight is you've heard a lot of tools, you've seen a lot of slides, you've heard some very, very knowledgeable people tell you how to do this. Now we're going to focus a little bit on why we want to do this. And where this comes up, several years ago I was at the Columbus Foundation. Again, there were some people there with lots of initials after their names. And the bottom line was, going through an hour of all this technical stuff, they said, tell the story. So that's what we're doing tonight, is we're going to tell the story. So let me introduce the panel. We have Phil Holly here. He's going to talk about appreciated stock. His daughter Lauren Norelli is going to talk about family giving. And you might know that the Holly family has been incredibly generous. They're now in their third generation. And I saw a bunch of little ones running around the other day, so I'm assuming they're being groomed. And then Lynn Ayers will talk about donor advised. We just mentioned that very much in passing, but Lynn will go into that in a little more depth. And I'm going to say just a little bit about RMDs. We heard about that quite a bit. But I'm just going to say that if you look at the ACORN, there's an interview with Sherry Van Cleef that is excellent to tell you about RMDs, and I wouldn't try to top what she said, but there's just a couple things. My experience has been when you're 70 and a half and you've got these IRAs, and all of a sudden you're going to get a big surprise. When the year after you're 70 and a half, when your accountant says, here's your income tax return, you say, wait a second, I'm retired, I have reduced income, why did I pay all these taxes? He or she's going to say one thing to you, RMDs. So you've learned about how to use that charitably. So that's really about all we need to say about RMDs. It's just a great tool, and I'm sure everybody learned that at the table. So Phil, why don't you tell us a little bit about appreciated stock?
Well, like Jim said, I'm a retired doctor, and I would first say that never a good idea to take financial advice from a retired doctor. So that's a bad idea, usually. But actually, the Johnson people are here, so you got to just tell me if I'm making a mistake. But I do have some experience in this arena here. I've been doing donations of appreciated stock for over 25 years, and it used to be difficult. Certain charities just really didn't know how to handle them. It was very hard, but it seems to be getting easier and easier to do. So why would you want to, and you all have been talking about this, and I'll try to do this quickly, but obviously the whole goal behind donating appreciated stocks is to bypass capital gains. And there just aren't that many ways to get past, get by capital gains. I mean, one is to die and leave the stocks to your kids, because the cost basis goes up to the day of your death, but you're dead, okay? So you can gift stocks to, if you have a family member who's a low-income family member, you can give stocks to that person, and they might, people like joint couples up to $77,000 pay no capital gains if their income's $77,000 and below. So that's a way you can counterbalance capital gains with losses, long-term losses. But again, that requires losses, which aren't good. And the final way commonly done is to donate to charity. And the charity gets the security, sells it. They get to keep all of it because they're a 501c3. They don't pay any capital gains, so that's the advantage. Is it hard to do? It's not hard to do at all anymore. It doesn't seem that way. I mean, you have to, first of all, there's a few steps. You have to give instructions. You have to make instructions to your financial institution. I used to donate appreciated stock to Princeton, where I went to school, and their instruction letter read just like this. It said, per our recent telephone conversation, I wish to make an irrevocable gift to Princeton University of X numbers of shares of XYZ Corporation. Please transfer the stock to Princeton University via the DTC number as follows. And that was it. One sentence instruction, all right? Then you need to give your financial advisors the information on the charity you're dealing with. And that deals with what's the name of the charity, where's the account, and what's the account number, and what's called the DTC number. Now, the foundation has put together this very nice how-to procedure. It's in your packet. So if you plan on donating appreciated stocks, you can take this sheet to your financial advisor, fill out the part you need to fill out, and that's all they need. All the numbers are on here. Cindy Sue is here somewhere. Where is she? Right back there. So she has it electronically. So you can call Cindy Sue, have her send it to you by email. You can email this to your financial advisor, do the whole thing in one email and one phone call. I made a donation of stock that we're going to talk about in just a little bit last week. It took me less than writing a check and putting it in the mail. I emailed this page to my financial advisor, one phone call to Cindy Sue to say that the stocks were coming, and that was it. The whole transaction, very easy to do. Just one other thing, who benefits by doing appreciated stock? The charity always benefits. The charity is always going to get more by you giving them appreciated stock than by you selling it and paying the capital gains. So that's one point. The donor sometimes benefits, and it has to do with everything we've talked about here, is whether you're doing the standard deduction or whether you're doing itemized deductions. I'm going to go through my case and just take 1 minute to do that, if that's okay, because I think it's a pretty good example of how this can work for you. So last week with Cindy Sue, we worked this out with my financial advisor at Morgan Stanley. I called him up and I said I wanted to make a donation of between $10,000 and $11,000 to First Community Foundation. I asked him, I want you to pick the stock. I want you to pick the one that has the most gain in it. He called me back and said it was Microsoft. I bought some Microsoft. It's probably the only good stock buy I ever made in my life. But I bought it for 25 years ago. And so we gave to the foundation 95 shares of Microsoft, which was worth $114 a share. So that's about $11,000. I had a cost basis of $1,000. Again, 25 years. So I had $10,000 worth of gain. All right. By giving it directly to the foundation, which I didn't have to do any of it, it was between the financial advisor and Cindy Sue, the church gets $11,000, and they sent me a nice sheet of paper and said they got $11,000 out of it because they sold it, but they don't pay any capital gains. So they get $11,000. I get to write off $11,000 deduction. This year I am bunching. I've got some charitable contributions obligations that I feel that I really need to live up to this year. So I'm making a lot of charitable contributions this year and none next year. And next year I'm 70.5. So I hit the mother load of donations, which is the RMD. Okay. So I'm itemizing this year, and so I get $11,000 less income this year. I think I'll be in the 24% tax bracket. So that saves me $2,640 in tax savings by getting the $11,000. So the church gets $11,000, I get $2,640 tax savings, and my cost basis on the whole thing was only $1,000. So that's a pretty good deal. If I would have sold it all over here, the church would have only gotten $9,500, and I would have gotten $360 less in tax savings. So it's just a win-win. It's a win for the church and a win for me, so it's great. And I just make one other comment, and then I'm sorry I talked too long. But it's also a good way to rebalance your portfolio. There's been so many stock gains over the last 10 years that a lot of your financial advisors are saying to you, your portfolio is out of balance. You got way too much in stocks, not enough in fixed income. And one of the great ways to do that is get rid of stocks and get rid of it through charity. All right. And I'm going to introduce my lovely daughter here.
I was gonna say I'm the finance person in the family, and I'm not gonna talk about any numbers. So you did a great job. So I'm just gonna give a little story about our family's experience in family giving, and really kind of maybe came about a little bit by accident, maybe was kind of a wonderful idea on the behalf of my grandfather, and it played out in a magical way, but I don't think any of us kind of knew what was going to happen. So in 2008, my grandmother, Lorena Hawley, passed away, and at the time, my grandfather asked his children, and so my dad and my uncle and my aunt, created a donor-advised fund here at the First Community Foundation. And it was 2008, and we did nothing for 5 years, which happened to be a very amazing time in the market. And by 2013-14 time period, it had increased substantially. And the foundation reached out to my dad and said, you guys really haven't done anything. What do you want to do? And at the time that they created the fund, they agreed that they wanted it to be focused on international mission work. And I, in that time period, had moved back to Columbus and had rejoined the church. And my dad said, do you want to, what should we do? What do you think? So we met with the foundation and we talked through it. And I said, well, I'll go meet with Kate Shaner and see what we can do with the fund. And spent an hour with Kate, and we talked through things. And, I think in our heads, we thought we might just kind of sprinkle some of the fund out over time. And Kate just looked at me and said, I have something that really needs your help. And she talked to us about the Dominica School and Orphanage, which the high schoolers at First Community had been visiting for about 8 years on a mission program in October. They're about to go next week. And she talked to us about they were in a really tough financial situation and needed our help. And my dad and I and Kate Shaner went down to visit the school and orphanage. And at the time, we felt like we would it would be very planned out, and we would just be making some sort of kind of annual distribution from the fund, and it would be all lovely, and it was kind of like, nice to meet you, and the check will be coming in the mail. And instead what happened was we were just amazingly impressed with the school and orphanage and the extent of their financial difficulties. And on the spot, on the last day before we left, we promised her a distribution, and we promised to raise more money. So at that point in time, it kind of spread to then the next generation. So what started as a fund that my grandparents and my dad and his siblings had started, and then my brothers and I got involved, and my cousins. And we decided also we would start another fund. And so we started a fund where we're actually out fundraising in addition to our family's fund. So it's really kind of grown and expanded, not just in our family, now broader. And the Zeigers have become very involved and been a huge part of the success. But I think from my experience, and one of the reasons we picked the Dominica School was partly because we had a vision too of, my brothers and I were in our mid-30s, had young children, and we have a vision of wanting them to be involved and taking them down with us and having them experience this, and us being involved, across 4 generations at that point in time. So and it's kind of one of those things where you talked about, Lynn, about the how, and this has been just such an interesting experience just because it's become so much more than just a gift. My dad and I talk about probably at least once a week, we have some discussion about Dominica. My brother and my dad are both physicians. My other brother and I are in finance. My sister-in-laws and my mom are teachers, and we all kind of bring some different skill set to this project and kind of interact with each other in a totally different way than doing this together as part of kind of a teamwork. And I have several cousins involved, so it's just kind of brought in. I don't think that's something that would have happened if the original fund hadn't been multi-generational to start. So I think my dad and his siblings had a very clear interest because they were involved in that initial gift. And that just brought the next generation along too. And something, we had totally unexpected, I think, at the time, and has turned into something much more.
Well, that was kind of the whole family. I've been kind of flying solo on my DAF. You've heard at your tables about the Donor Advised Fund. It's the fastest growing philanthropic vehicle, and you've heard that they're kind of like charitable savings accounts where you put money in, you can keep putting money into your Donor Advised Fund, and then you make recommendations through grants to give that money over time to charitable organizations. And you have a brochure in your packet that kind of explains First Community Foundation is going to be offering Donor Advised Fund accounts, and we're going to be working in partnership with the Columbus Foundation, who's going to administer the funds, invest them, and administer them. So this is something that we really would like to talk to you about if you're interested in a Donor Advised Fund at First Community Foundation. I seeded my First Community Foundation DAF account. It's called the Lynn Ayers Fund. That was really creative. I did this in 2000. I had been managing a corporate philanthropy program whose mission was to assist nonprofit organizations' clients with essential needs such as food, clothing, and shelter. That was kind of their philanthropic strategy. And I wanted to continue, when I left the company, my passion for this work. I'd met a lot of nonprofit organizations and their leaders, and I knew that this was still a very huge need. The company I was working for at the time had since not only contributed to my DAF when I left the company, but to this very day, they are still using the strategy of funding nonprofit organizations for essential needs such as food, clothing, and shelter throughout the state of Ohio. So I don't think anyone knows that no one knew that I really had a Donor Advised Fund, and in fact, a lot of my friends really didn't even know what they were. I consulted my financial advisor, which is probably the most popular phrase that you're going to hear after this all these tax laws is contact your financial advisor and be sure you talk to your financial or tax advisor. So I did that, and I talked to Don Jameson, who is the director of the foundation, the first director of the foundation, and we agreed that this gift would capitalize on my knowledge of the nonprofit sector in Ohio, and particularly Franklin County. And it was a way for me to give back to the community at large. I really wanted to do that, help our brothers and sisters in Christ who really lack food, clothing, and shelter. So I wrote a letter about my intent, sent it into Don Jameson. Over a 3-year period, I fulfilled what my commitment was. And I got recognized by the church as a member of the Heritage Society, which I think now is the Legacy Society, but that was a big deal. And since then, I have funded about a dozen nonprofit organizations with probably over $25,000 from my DAF fund, and it's still building. Some other people give to it. Some of the organizations that I funded: Dress for Success Columbus, the Furniture Bank, Godman Guild's Blue Bow Ties Catering Service, Central Community House, and First Community, it's gigantic garage sale. They have a lot of administrative costs now, so I've been chipping into that. I'm very engaged with the organizations that I fund. I go out and visit with them. I follow up with them. They ask me to read their grants before they submit them, and I'm very proud of the selection I've made of the donor advised funds that I've given out, and I'm just so impressed with the impact that they've made in these communities. So I'm going to continue to do that. To me, DAFs are a very simple and efficient way to give money. They started back in the 1930s because people were thinking that they were going to set up their own family foundation, and that was actually kind of complex and could be expensive. So this is kind of the cheap way of, you know, of doing this, and you don't always have to know. I mean, I know a lot of these organizations, but certainly our director here for the foundation can assist you or anyone who sets up a DAF fund to know where to put it, because there's just tremendous need out there. So we're looking forward to working with the Columbus Foundation. Over half of their assets are actually donor advised funds, and I'm just, you know, very excited about the impact my DAFs have made. And I've been kind of flying solo on it.
Thank you.
You want to wrap up? Oh, yeah. Yeah, so we need to wrap up. Our time is up, but I would like to introduce, that kind of concludes our formal part, but I'd like to introduce the executive director of the First Community Foundation, and she's also the director of stewardship for First Community Church, so she's playing a dual role. Her name is Linda Silva, and she's been with us for about 8 months.
8 months.
So Linda, take it away.
Thank you. I'll be brief, I promise. I just want to thank y'all for coming out and taking the time to learn a little bit more about how the tax laws are going to be affecting your family and your charitable giving. And what is really, really clear to me tonight is that no one has a real crystal ball to know what's going to be happening in the future. But what do we know? I know that Americans are extraordinarily generous people. In 2017, they gave away $410 billion. That's a B, billion dollars. And you know, 31% of those funds went to churches or religious organizations. And believe it or not, I don't think it's hard to believe, but Central Ohioans actually are top the list in terms of the national average. Now, some experts predict that nonprofit organizations may lose between 12 and 30 billion in charitable gifts resulting from these increases in the standard deductions. I don't agree. I do not buy that a prime motivator for charitable giving is a desire to reduce or eliminate your taxes. When the standard deduction was introduced over 100 years ago, the view that funds voluntarily directed by taxpayers to meet the broader social needs should not be part of taxable income. And that hasn't changed since 1917, except with some limits. As Director of Stewardship for First Community Church and Executive Director of this foundation, my role is to listen to your interests and coach you on the options that you have as a donor within the foundation. After you've met with your tax advisors, your attorney, and your family, I would welcome the chance to customize a plan for you that will fulfill your giving desires and goals. My business card is inserted into each of the green folders. Please feel free to reach out at any time. Now, a final bit of housekeeping, and this is really, really important. Inside your green folder is our evaluation form. We want to improve on these events for you, or any other kind of event that you think would be helpful to you going into the future. Fill it out, take it home, bring it back, but just please give us as much detailed information as you can. Thank you for coming, and please have a safe journey home.